Hi, I'm Paul Mowbray, President of Mowbray Wright Financial Investment Planning Council. In this video, I'll compare the pros and cons of investing in stocks, gold, or real estate. Many options when it comes to investing. Picking what is right for you is not an easy task. There's no clear best option, but I will try to show you some of the benefits and drawbacks of three types of investments. We're only comparing three asset classes here, not to say you should not consider others, such as bonds, GICs, mutual funds, ETFs, for your portfolio as well. Diversification is key. Gold is a good investment to have as a safe haven. It's a strong, stable addition to your portfolio and typically suggested to have about 5% or less in your portfolio. Since the value of gold does not directly correlate with the stock or bond market, it is a good way to diversify your investing and can decrease your portfolio's volatility. Gold is a good hedge against inflation and the ups and downs of the stock market. However, it is not for everyone and is often suggested for the wealthy as a way to protect against inflation. Many different ways to invest in gold. You can own gold bars, coins, ETFs, gold stocks, flow-throughs, mutual funds. Gold has been around longer than almost any other type of investment and has stayed stable for hundreds of years. There is a level of reassurance knowing that it has held its value so well for so long. Gold has no income. It does not help the economy grow. It does not pay dividends and it does not generate income for its owner. It is simply a commodity that you hope has an increasing value. It can be an extremely volatile asset in the short term. Gold is an investment that everyone is aware of and talking about, and this means that it is not in the early phase like a junior tech stock with the possibility of rapid growth. Gold is typically the most volatile option out of the major forms of investment. Over the past 10 years, gold has had an average return of 5.3% per year. Stable and acceptable. However, to illustrate the volatility of gold, in 2007, gold had an average return of 31.6 and the US stock market had a return of 5.5. In 2013, gold had an average return of negative 25%, where the US stock market averaged plus 28%. As you can see, gold tends to do well when stocks don't, and vice versa. Investing in real estate means to purchase a property that generates income or is otherwise intended for investment purposes. The house you purchase to be your primary residence is not an investment. You live there. Investing in real estate can be extremely profitable and has potential for spectacular growth. A cottage you may have bought 30 years ago for $30,000 might be worth $300,000 today. But real estate requires more diligence and analysis at the time of purchase. You need to buy right, as well as more time and commitment over the years. Patience pays off. If investing in real estate requires more effort and time than other forms of investment, why would you do it? For starters, you can save some tax. There's certain expenses from owning real estate that you're able to deduct from your income. This list includes mortgage interest, property taxes, insurance, property management, and utilities. If you lose money because your expenses exceeded your rental income, then you may be able to deduct the loss from your earned income. And lastly, you get a regular monthly income if you rent out the house. This helps cover the expenses of the investment and can be a nice income when the mortgage is paid off. Well, you're now a landlord. Rental units need repair, sometimes immediately. If you are the one doing the repair, it can be extremely inconvenient and aggravating. If you're planning on hiring a property manager, their salary must be factored into the total cost. It also may be hard to sell the property, as real estate is not a liquid investment and the timing can be very bad. Initially, it may be difficult to finance the purchase, and you may be required to put down a payment of at least 20% and then pay principal and interest monthly to finance the mortgage. Real estate returns are hard to measure. It depends on whether you had to take out a loan to purchase the property, what the interest rates were at the time of the purchase, and whether you've been renting the property out, as well as your expenses and taxes on the property. Too many factors to suggest exactly what return you may achieve. However, the average gain on real estate over the past 10 years was 5.4% and 4.5% over the last 20 years. The stock market allows investors to participate in the financial achievements of the companies whose shares they hold. This is realized in two forms: a regular and increasing dividend payment and an increasing stock price. There is the possibility for huge returns, or you can lose a chunk. At Mowbray Wright Financial, we use customized, managed portfolios to help you get the benefits and returns of the stock market while keeping your portfolio diverse enough to keep the risk to a minimum. You can choose to invest in up-and-coming companies by choosing a growth portfolio, or you can keep it safer with a more diversified and balanced portfolio and typically stable but lower returns. Stocks typically have greater potential for higher returns than other forms of investment long-term. They have the potential for unparalleled returns if the company has extreme growth. For example, if you had invested in Netflix on January 1st, 2013, by December 31st of that same year, your investment would have grown by 300%. That kind of return is something only the stock market can yield. Some stocks pay dividends in addition to the change in the share price, and this allows profit even if the share price doesn't increase. Also, your stock portfolio is normally very liquid. You can cash out in minutes if you need to. Three main cons. Stock prices can be volatile in the short term. It is difficult to determine when to sell. It's easy to buy. And third, there is no guaranteed return. It's hard to measure the exact return of the overall stock market. Typically, the most agreed upon way to measure the approximate return of the stock market is the S&P 500 index, which is an American stock index based on 500 large companies listed on the NYSE or NASDAQ. Over the last 10 years, the S&P has delivered a return of about 7% annually, and over the last 20 years, the average return was around 9%. Let's compare 100 years of returns. Gold, 4.32%, real estate 3.1%, stock index 7.44%, inflation 3.18%. Gold, $6,800, real estate, $2,100, stock index, $130,000, and inflation, $2,200. Investing is a complicated process. It takes time, expertise, and a deliberate plan. If you want a plan or further clarification about anything discussed in this video, please contact me. I'm Paul Mowbray, and I'll see you on the next video.